In 2007, MBIA was the largest bond insurer on Earth, and almost nobody outside finance had heard of it. That was by design. MBIA did not lend money or build anything. It sold one thing: its own reputation. By 2007, it had used that reputation to guarantee hundreds of billions of dollars of bonds, and the handful of companies in its industry together stood behind more than $2 trillion of debt. Then, in the span of 2 years, MBIA's stock fell more than 90%. The reputation it sold was destroyed, and for a few terrifying months in 2008, regulators worried that the failure of companies like it could pull down a huge part of the financial system. To understand how that happened, you first have to understand the strangely simple business MBIA was in. If you find these breakdowns useful, hit subscribe. We're pushing for 100,000 this year, and it genuinely helps. Imagine a small town that wants to borrow money to build a school. It does this by selling bonds, which are basically promises to pay investors back with interest. But investors do not know this town, so they worry, even a little, that it might not repay them. To cover that worry, they demand a higher interest rate, which costs the town more. Now imagine a company with a perfect credit rating steps in and says, if this town ever fails to pay you, we will pay you instead. Suddenly the bond is as safe as that company's promise. The town borrows at a lower rate, investors get a guaranteed payment, and the insurer pockets a fee for taking on a risk it is betting will never happen. That company was MBIA, and the only thing it was really selling was its AAA rating, the highest grade a borrower can have. The business began in 1973 as the Municipal Bond Insurance Association, a group of insurers formed to guarantee American city and state debt. And it turned out to be a wonderful business because American towns and states almost never default. They can raise taxes and they do not disappear. So for decades, MBIA collected fees on bonds that hardly ever went bad. It was close to free money. The company went public, grew into the giant of its industry, and its entire value rested on one fragile thing: that perfect rating. As long as MBIA was rated AAA, it could lend that rating to everyone else. Without it, it had nothing to sell. The problem with the safe business is that it grows slowly, and Wall Street always wants more. So beginning in the late 1990s, MBIA and its rivals started guaranteeing a very different kind of bond. Instead of schools and sewer systems, they began insuring structured finance, complicated securities stitched together from thousands of home loans, including risky ones. The fees were bigger and the volumes were enormous, but MBIA was now lending the same precious AAA rating earned on bonds that never defaulted to mortgage products that almost nobody fully understood, on the assumption that American house prices would keep rising forever. One investor thought this was insane. In 2002, a hedge fund manager named Bill Ackman published a report bluntly questioning whether MBIA deserved its AAA rating at all. He argued the company had taken on far more risk than it could ever cover, and that if the mortgages behind its guarantees went bad, MBIA simply did not have the money to pay. He then placed a bet that it would fail using credit default swaps, which are essentially insurance contracts on a company's debt that pay out when that company gets into trouble. In other words, Ackman bought insurance against the insurer. The response was extraordinary. Instead of investigating MBIA, regulators investigated Ackman. New York's Attorney General and the Securities and Exchange Commission looked into whether he was spreading fear to profit from it. For years, he was treated as the villain, while MBIA kept its rating and kept piling into mortgage-linked bonds. He held his bet and waited. He did not have to wait much longer. Starting in 2007, American homeowners began defaulting at rates no one had modeled, and the mortgage securities MBIA had guaranteed started to collapse in value. The claims the company had assumed were nearly impossible were suddenly real, and they were gigantic. MBIA had taken in small fees to guarantee these bonds. Now it was on the hook to pay out sums that dwarfed everything it had ever collected. In early 2008, MBIA raised about $2.5 billion in emergency capital and promised to stop insuring structured finance, all to protect the rating that kept it alive. It bought a few weeks. Then the wall came down. In April 2008, Fitch cut MBIA from AAA to AA. In June, Standard & Poor's did the same, and days later Moody's slashed the rating by several notches at once. This was the death blow because MBIA's whole business was renting out a AAA rating. Once it no longer had one, there was nothing left to rent. No town would pay MBIA to borrow a reputation it had lost. And here is why this was not just MBIA's problem. Remember that the bond insurers collectively guaranteed more than $2 trillion of debt. Every one of those bonds borrowed its safety from the insurer. So when the insurers were downgraded, all the bonds they had guaranteed risked being downgraded too at the same moment, no matter how healthy the underlying borrower actually was. Banks that held those bonds would have to mark down their value and report huge losses. Pension funds and money market funds that were only permitted to hold the safest assets might be forced to dump them. The bond insurers had quietly become a hidden support beam holding up the credit markets, and that beam was buckling in 2008 just as Lehman Brothers failed and the entire system locked up. MBIA's stock told the story without words. Shares worth around $70 in 2007 fell to a few dollars, and in January 2009, Bill Ackman finally closed his bet after nearly 7 years, walking away with an enormous profit. The man regulators had treated as a manipulator had been right the whole time. But MBIA refused to die, and what it did next started a brand new war. In 2009, with the blessing of New York's insurance regulator, it split itself in two. One new company, National Public Finance Guarantee, was given the safe, healthy municipal business. The other, the old MBIA Insurance Corporation, was left holding all the toxic mortgage guarantees. MBIA called this survival. The banks owed money on those toxic guarantees, called it a swindle, arguing MBIA had scooped out its good assets and left them to claw at a hollow shell that might never be able to pay. 18 banks sued to undo the split. The biggest fight was with Bank of America, which had absorbed the disastrous mortgage portfolio of Countrywide, the subprime lender it bought during the crisis. MBIA accused Countrywide of lying about the quality of the loans behind bonds MBIA had insured and demanded to be paid back. The two sides fought for years, and MBIA came dangerously close to running out of cash, later admitting it had risked being forced into liquidation before the case ended. In March 2013, a New York court handed MBIA a decisive victory. 2 months later, Bank of America gave up. It agreed to pay MBIA roughly $1.5 billion in cash, hand over additional notes, drop its challenge to the split, and extend a $500 million credit line. MBIA's stock jumped as much as 57% in a single day. The company had survived. But surviving is not the same as recovering. Trust in bond insurance had evaporated, and demand for it never came back. By 2017, even MBIA's healthy municipal unit stopped writing new policies. Today, the company barely operates as a business at all. It mostly exists to slowly pay off the guarantees it made long ago, its largest remaining worry being its exposure to the troubled finances of Puerto Rico. Its book value is deeply negative. It is, in effect, managing its own slow retirement. The lesson of MBIA is simple. For decades, it ran a genuinely safe business by lending its good name to borrowers who almost never failed. The moment it lent that same good name to things it did not understand, its single greatest asset, that perfect rating, became the fuse on a bomb. And because so much of Wall Street had quietly come to lean on insurers like it, MBIA's near collapse was never just its own problem. It was very nearly everyone's.